For years, if you mentioned Dredging Corporation of India or DCI to an investor, he'd probably get a shrug. It was seen as a slow, sleepy public sector unit, a classic value trap. But, over the last few years, something has fundamentally starting to shift. So today, we're asking a pretty simple question. Is this the beginning of a real turnaround? Let's dig in and analyze the key factors that could be driving this change.
So to really get DCI, you first have to understand what it does. Think of it as the silent guardian of India's maritime trade. It's the company that keeps our ports from silting up and shutting down. But look, just being a guardian isn't enough anymore, right? The real story we're unpacking here is its journey. Its attempt to go from being a legacy utility to a potential modern powerhouse.
So what lit the fire under this whole thing? It all comes down to a single transformative event back in 2019. And I want to be clear, this wasn't just some small course correction. This was a massive strategic pivot that basically rewired the company's entire DNA.
Okay, this is the most important part. This wasn't a standard privatization where you just sell to the highest bidder. Nope. Instead, the government pulled off a really clever strategic handoff. It sold its stake to a consortium of DCI's biggest customers, 4 major ports. This was a game changer because it was designed to perfectly align DCI's interests with the very organizations that absolutely depend on it.
And this timeline here really maps out the journey since that handover. You can see a very clear, very logical progression. First, you stabilize the company during the ownership change. Then you focus on rationalizing costs. And only then, once the house is in order, do you pivot to modernization and actual growth. It's straight out of a classic turnaround playbook.
So, with that background, how does this all build into the bull case, the optimistic view? Well, let's break down the core arguments for why DCI's future could look a whole lot brighter than its past.
The bedrock of the entire bull case is DCI's core business, maintenance dredging. Just think of it like essential plumbing for our entire maritime trade. Ports naturally fill with silt. It's a fact of nature. If you don't constantly clear it out, those massive container ships simply can't get in. What this does is it creates a recurring, almost utility-like revenue stream that isn't really tied to the ups and downs of the economy.
This creates what you could call a moat of necessity. I mean, its owners are now its biggest customers, which pretty much creates a captive market. It already has a dominant share of these must-have maintenance contracts. And maybe most importantly, its mission is now perfectly aligned with huge government pushes like the Maritime India Vision and Atmanirbhar Bharat.
And hey, don't just take my word for it. You can hear it straight from the management. This quote signals a huge change in their thinking. The language isn't about survival anymore. It's about active growth. And notice the key promise right there, lowering operational costs. In a capital-intensive business like this one, that's everything. That's where you're going to see the real margin improvement.
And here's the proof in the pudding. This isn't just talk. The company has put its money where its mouth is, placing a landmark order for a massive 12,000 cubic meter dredger. And it's being built right here in India, at the Cochin shipyard. This is the Make in India plan in action, and it's the first major CapEx spend in a fleet modernization that is, frankly, long overdue.
But, of course, no turnaround story is ever that simple. To get the whole picture, we have to put on our skeptical hat and really look at the bear case. Because there are some pretty significant challenges. You could say the weight of the company's past that could easily derail all this progress.
This table lays out the central problem in black and white: asset obsolescence. On the left, you've got the current reality, an old, inefficient fleet with high operating expenses. On the right, you've got the vision, a modern, efficient, profitable fleet. The gap between those two columns? That is the core execution risk for this entire company. And that main problem, the old fleet, it creates a whole cascade of other risks. Your working capital gets stressed because government project payments can be painfully slow. You've got concentration risk because too much of your revenue comes from just a few big ports. And with old, fuel-guzzling ships, the company is incredibly vulnerable to any spike in global oil prices. This is the Achilles heel of the whole operation.
Okay, so we've got a compelling bull case built on strategic alignment and a strong moat. And we have a pretty sobering bear case rooted in these legacy issues. So how do we square the two? Let's boil it all down to the single most important factor you need to be watching.
When it comes right down to it, the entire turnaround story for DCI really hinges on one critical variable. It's not about whether the strategy is right. I think we can all agree it is. It's all about the pace of execution. To be specific, how quickly can they replace these old, high-cost vessels with new, efficient ones? Every other financial metric, your margins, your profits, it all flows from this one thing.
So that leaves us with the final critical question for anyone tracking this company over the next, say, 12 to 24 months. The new ships are on order, the strategy's in place, but in this race between modernization and obsolescence, will the new fleet actually get here fast enough to turn the tide? That, right there, is the verdict we're all waiting for.